9:47 a.m. Eastern Standard Time. COMEX silver futures just spiked to $30 per ounce, and the spread between paper and physical has exploded to $3.50. The bid-ask gap is widening at a rate that shouldn't be possible in normal market conditions. Physical dealers across the United States are posting sold-out notices, while COMEX screens show relatively calm trading. Meanwhile, premiums on physical silver bars have hit 20% above spot, a number that signals something fundamentally broken in the arbitrage mechanism. Paper prices remain anchored near $28, while physical silver is trading hands at $35 per ounce in cash transactions. This is not market volatility. This is not a temporary dislocation. This is the beginning of a supply crisis that will redefine precious metals markets. At 9:50 a.m. Eastern, silver futures surged $1.50 per ounce in exactly 2 minutes. The rally appeared on every trading screen from New York to Chicago, but something was missing: the physical supply that should have flooded the market to capture that arbitrage opportunity. COMEX futures were rallying, yes, but the mechanism that should have brought physical metal to market had vanished. Dealers who normally would have rushed to sell into that spike were instead updating their websites with out-of-stock notices. The explosive rally was completely detached from the real-world silver supply. Every trader watching that 2-minute candle understood they were witnessing something abnormal. The paper market was moving, but the physical market had stopped responding. That divergence, that failure of arbitrage, was the first signal that the system had fundamentally broken. By 10:10 a.m. Eastern, the spread between paper and physical had widened to 2.0 per ounce. COMEX silver futures were trading below what physical dealers were quoting for immediate delivery. The price divergence was no longer a momentary anomaly. It was a persistent signal of market dysfunction. In normal conditions, arbitrageurs would have immediately exploited that gap, buying paper contracts and selling physical metal until the spread collapsed. But the arbitrage wasn't happening. Physical inventory simply wasn't available at the prices paper markets were showing. Dealer sites across North America displayed identical messages: limited availability, extended wait times, suspended orders. The massive spread between paper and physical prices was a red flag that the connection between futures markets and physical delivery had severed, and that severing was about to get much worse. At 10:30 a.m. Eastern, a dangerous divergence emerged between Western and Eastern markets. COMEX screens showed silver trading at $28 per ounce. Shanghai physical markets were reporting transactions at $35 per ounce. $7 separated the paper price in New York from the physical price in China, a gap that represented not just geographic arbitrage but a fundamental market fracture. Under normal conditions, metal would flow from low-price regions to high-price regions until prices converged. But metal wasn't flowing. Export constraints, delivery delays, and inventory depletion had created two separate silver markets operating at incompatible prices. The Asian premium wasn't just higher, it was accelerating. Every hour that passed without convergence was proof that the global silver market had fragmented into paper and physical domains that no longer communicated through price. That fracture would define everything that followed. At 10:45 a.m. Eastern, the arbitrage mechanism that should have reconciled paper and physical prices had completely broken down. Premiums on physical silver had risen 25% above COMEX spot prices, creating what should have been an irresistible profit opportunity. Buy paper contracts at $28, take delivery of physical metal, sell that metal at $35, instant profit with minimal risk, except the arbitrage wasn't available. COMEX delivery schedules were extending into future months. Physical dealers had no inventory to sell at any price close to spot. The paper contracts that promised delivery were facing a supply chain that couldn't deliver. The price divergence was clear and documented across every venue, but the system couldn't reconcile it. Traders were stuck watching paper prices drift sideways while physical premiums climbed into territory that historically preceded market breakdowns. The arbitrage failure wasn't temporary, it was structural. By 11:00 a.m. Eastern, physical dealers were reporting complete inventory depletion. The phrases appearing on dealer websites were identical: out of stock, no estimated restock date, back order only. One major dealer in Texas posted a simple update: sold out, no ETA. This wasn't a supply hiccup, it was a liquidity vacuum. Physical silver bars, coins, and rounds that had been available for immediate purchase days earlier had vanished from retail markets. The inventory depletion was sparking panic among buyers who suddenly realized that paper promises and physical metal were not the same thing. Premiums continued rising not because dealers were greedy, but because they genuinely had nothing left to sell. Every phone call to a dealer, every website refresh confirmed the same reality. Physical silver was no longer available at prices anywhere near what COMEX screens were showing. The panic was just beginning. At 11:30 a.m. Eastern, the divergence between paper and physical had reached catastrophic proportions. COMEX futures were showing a price of $30 per ounce. Physical markets, where actual metal changed hands, were hitting $38 per ounce. $8 separated the screen price from the street price. This wasn't a pricing discrepancy that could be explained by transportation costs or dealer markups. This was a systemic collapse unfolding in real time. The paper market was insisting that silver was worth $30 while the physical market was proving that silver was worth $38 and unavailable even at that price. Futures traders staring at COMEX screens were living in a different reality than physical buyers calling dealers. One market was calm, the other was in chaos, and the longer that divergence persisted, the more obvious it became that one of these markets was lying. By 11:45 a.m. Eastern, lease rates for silver had begun to spike, a technical signal that industrial users and financial institutions were scrambling for physical metal. Lease rates measure the cost of borrowing silver for short-term delivery, and when they spike, it means someone desperately needs metal they don't have. The rates had jumped from near 0 to 8% annualized in less than 3 hours. That move signaled that entities with short positions, banks, hedge funds, industrial manufacturers, were facing potential delivery failures. They were willing to pay nearly any price to borrow silver temporarily, rather than admit they couldn't deliver on their obligations. Meanwhile, COMEX open interest remained elevated, meaning thousands of contracts were still outstanding with delivery obligations that were mathematically impossible to fulfill from available inventories. The lease rate spike was the market screaming that a delivery crisis was imminent. At 12 p.m. Eastern, COMEX silver futures began showing signs of backwardation, a condition where near-term contracts trade at higher prices than future-dated contracts. Backwardation in commodity markets is rare and alarming because it signals that immediate physical supply is more valuable than future supply. In normal markets, future prices are higher than spot prices to account for storage costs and interest rates. But when spot prices exceed future prices, it means the market is screaming for metal right now and doesn't care about next month or next year. The backwardation was forcing paper contract holders into a nightmare scenario. They could either roll their contracts forward at a loss or demand physical delivery into a market with no available inventory. For anyone holding paper contracts expecting easy delivery, the nightmare settlement was approaching fast. By 12:15 p.m. Eastern, gamma pressure from options markets was compounding the delivery crisis. Silver call options with strike prices that had seemed safely out of the money days earlier were now deep in the money as prices spiked. Market makers who had sold those calls were now forced to hedge by buying futures contracts or physical metal. But physical metal wasn't available, forcing them to buy more futures, which pushed prices higher, which brought more call options into the money, creating a feedback loop. The gamma squeeze was forcing delivery issues across the entire derivatives complex. Every option's expiration date became a potential trigger point for forced delivery that couldn't be fulfilled. Paper market players who had written covered calls or sold naked puts were now facing forced delivery obligations into a market with zero available inventory. The squeeze wasn't theoretical anymore, it was mathematical and unavoidable. At 12:30 p.m. Eastern, geopolitical tensions were tightening the noose on global silver supply. Major silver-producing nations, Mexico, Peru, China, were facing political instability, environmental protests, and export restrictions that threatened mining operations. Mexico, the world's largest silver producer, was dealing with mining permit delays and cartel violence in silver-producing regions. Peru was experiencing social unrest that had already shut down several major mines. China was quietly restricting silver exports to preserve domestic industrial supply for its technology sector. These weren't temporary disruptions. They were structural constraints that would limit physical supply for months or years. The geopolitical factor meant that even if prices rose dramatically, new supply couldn't materialize quickly enough to relieve the squeeze. The physical silver shortage was being reinforced by forces completely outside market control. The worst was yet to come. By 12:45 p.m. Eastern, reports were emerging that some COMEX short positions were being forced into cash settlement rather than physical delivery. The exchange rules allowed for cash settlement under certain conditions, but those conditions were now being triggered at scale. Traders who had sold silver futures expecting to deliver physical metal were instead being forced to close their positions at massive losses because they couldn't source the metal. The cash settlement mechanism, designed as a safety valve for rare edge cases, was becoming the default outcome for a significant portion of open interest. This was the trap. Paper sellers had made promises they couldn't keep, and the exchange was allowing them to pay cash penalties instead of delivering metal. But those cash penalties were massive, and they were getting larger as the spread between paper and physical continued to widen. At 1 p.m. Eastern, the spread between paper and physical silver had widened to $6 per ounce. COMEX screens showed $30. Physical transactions were occurring at $36. The forced settlement and physical inventory depletion were driving the price hike into territory that most analysts hadn't considered possible. Every forced cash settlement represented another failure of the paper market to deliver physical metal. Every dealer reporting zero inventory was proof that the paper price was divorced from physical reality. The endgame pricing scenario was unfolding. Paper markets were approaching implosion, while retail investors holding ETF shares and unallocated accounts were stuck with claims on metal that didn't exist. The paper-silver market had grown far larger than the physical silver market, and now that mathematical reality was asserting itself through violent price dislocations and delivery failures. At 1:30 p.m. Eastern, COMEX registered silver inventories. The metal actually available for delivery had fallen to critically low levels. The inventories that backed millions of ounces of futures contracts had been depleted to levels not seen in decades. Physical premiums at dealers were soaring past 30% above spot as remaining inventory vanished. The silver squeeze would only accelerate from here. Prices were poised to explode higher because the fundamental constraint, physical supply, couldn't be overcome with paper promises or cash settlements. Every industrial user, every technology manufacturer, every jewelry maker who needed physical silver was now competing for a shrinking pool of available metal. The math was simple and brutal. Demand exceeded supply, and no amount of paper trading could change that. The spread that opened at $0.90 that morning closed at $7. The system that was supposed to arbitrage it never showed up.